Hey guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra Parekh. You're tuned into Mutual Fund Corner, and today we're going to talk all about how you can really create an aggressive mutual fund portfolio. So what are the key characteristics? Who is this kind of portfolio best suited to? And what are the guiding rules that you should really follow? We've got all of that covered. Not just that, we've also done the math for you, and we're going to help you understand what you will need and the kind of money you will need to put in if you want to get to, say, 5 crores in a period of 10 years or 10 crores in 20 years. So for this very interesting chat, I have with me Nirav Karkera, who's head of research at Fisdom, and he's joining me now on the show. Nirav, it's always a pleasure to talk to you. So thank you so much for joining us. And I think this is a very interesting topic, right? Because a lot of investors who are perhaps a little bit younger want to take that aggressive approach. They're looking at creating large sums, you know, even if it's a little bit into the future. So I think this will be very helpful for a lot of people. For starters, let's just talk about what an aggressive portfolio really looks like. How would you classify it, and what do you think the main characteristics of such a portfolio really are?
So that's a very pertinent question. So Pavitra, often when we talk about an aggressive portfolio, I feel it is very important to, dispel the myth right at the outset and bring to notice that, there is a very fine difference between being aggressive and being reckless. Okay, so what an aggressive portfolio basically tries to do is that it tries to maximize returns while not offering as much weightage to the risk involved in it. So it is a return maximization strategy versus most conventional strategies that seek to optimize for risk or minimize for risk. So this is basically aggressive investing. Now there's a very fine distinction that one needs to recognize, that it does not ignore the element of risk, but it does not mind taking on additional risk as long as it comes with the incremental probability of generating a whole lot higher performance, right? So this is what aggressive investing is all about. One must understand that aggressive portfolios can be created while maintaining asset allocation discipline. The second myth, which is very popular and rampant about aggressive investing and aggressive portfolios, is that it needs to be a 100% equity portfolio. That is not the case. An aggressive portfolio simply tries to maximize your returns basis whatever your strategic asset allocation is. So within the specific asset classes, you must be taking aggressive calls in order to create a portfolio that's really aggressive. You do not need to change your asset class orientation completely just to build an aggressive portfolio. One example that I could give is that, while building an aggressive portfolio, you're not looking for the Gadar wala, Sunny Deol wala action, jahan par you have to uproot the entire hand pump, right? It is far more nuanced. It is much more Jackie Chanish, wherein there's a lot of action happening. Yet at the same time, the purpose is still being achieved, without really uprooting hand pumps and making the earth split into two. So this fine distinction is something that differentiates aggressive portfolios from reckless portfolios.
That's a very helpful example to give, Nirav, and I'm sure that it will benefit all of our viewers tuning in, that this is somewhat of a warning, right? That just because you are trying to create an aggressive portfolio, there's no need to be that reckless in this respect. But think about, if, for example, someone has decided that they want to create an aggressive portfolio, how do you really decide whether this is suitable for you or not? Is there a list of sort of check-ins you need to do in order to understand if this is good for you?
Yeah, absolutely. So an aggressive portfolio inherently entails a lot of risk. So the answers to this also lies within and not outside. You must understand whether your own appetite for risk is in alignment with such an aggressive portfolio. You must understand that an aggressive portfolio primarily serves the purpose of wealth creation. Most other goal-oriented investments, which have a very short to medium-term tenure, may not really be the ideal sort of a portfolio wherein you can take on a lot of aggressive calls. But if you are investing for the longer term, you have the appetite for volatility, and your primary purpose is wealth creation or a very far off goal. Let's say if you're a young earner and who's probably just started off earning, and you want to invest towards your retirement, and I'm talking about normal retirement, not the early one. So you can take on such aggressive bets and can create a portfolio with such aggressive bets. So basically, the three most important things to consider is one, your own risk appetite. That is basically your appetite for volatility. What is your timeline or the time horizon that you have in hand? So if you can stay put for 10, 15, 20 odd years, you're good to go. And third, how critical are your goals? Like, for example, if you're saving towards buying your first home or buying your first car, or towards your own marriage or probably higher education, you don't want to take on a whole lot of risk there, because these goals are not really fungible. You cannot postpone these things indefinitely, at least most of these things. So it also really depends on what your objective is. So if your objective is simply to create wealth, I feel that's the best fit for such aggressive portfolios.
Okay, got that. Perhaps not great for this kind of goal-based investing, but if you're just looking to generate wealth, this is perhaps a good strategy. Nirav, now consider that you've decided, okay, fine, an aggressive portfolio is for me. I am going to get into this. How do you go about it? Is there a step-by-step approach that you could take us through? Because you did still mention that, you do have to maintain your asset allocation. There is a certain framework within which you do function.
Yes, absolutely. So nothing in investing must be done without a framework and without a checklist. At the risk of sounding cliched, we know that the best pilots also still carry a checklist. So that's what even successful investors do, and that's something each one of us must recognize. So while approaching aggressive investing, the very first step, like I always say, answers lie within, at least the primary ones. So understand your risk profile, your time horizon, and the objective for which you're going to invest, and in line with that, develop a broader asset allocation framework. Okay, so you could have a certain bit of fixed income also in your portfolio. You could have equities also in your portfolio. You must understand that fixed income also has a very important role to play. Quite often than not, people, although you refer to fixed income or debt as debt, but you start treating it as non-equity. So basically, many people tend to look at fixed income simply as a non-equity allocation, but understand that there are indeed periods where fixed income has the ability to outperform equities, at least on a risk optimized basis, and at least in the shorter term and intermittent terms. Think about periods where equity markets are undergoing a secular downturn, and at that point in time there are great opportunities offered by fixed income opportunities. Talk about periods where markets are generally sideways, equity capital markets are generally sideways, right? So please understand the value that each asset class brings to the table and try to optimize for each of it. So number one, once you decide your broader asset allocation framework, that's when you decide your asset categories and instrument categories. So now within equities, how much are you going to invest directly in stocks, and how much are you going to invest in mutual funds, how much are you going to invest in any other equity linked product? That's on one side. On the fixed income side, how much are you going to invest in mutual funds, how much are you going to invest in probably a bond or an NCD, right, if you are that savvy. So whenever you develop such strategies, you need to bear one most important thing in mind, is that while most normal investment strategies are optimizing for your financial goals, your risk appetite, your investment style, an aggressive portfolio is trying to optimize for the market cycle, for the business cycle, for the economic cycle at large. So you want to build a portfolio that gives you the ability to play each of these outside cycles in the best possible fashion. Right. So then you create your second layer, which is your instruments of choice. And within that, you make some really, really smart choices. So the most important element of building an aggressive portfolio is, it is dual faceted. The first side is about building conviction into a story that most people are not really fond of at the moment. It may require you to go against the grain, but you really need to do some hard work and build conviction into something that is not in favor right now. That will give you disproportionate returns. And secondly, is sizing of your bets, right? So once you have built conviction, it is important that you size your bets accordingly. So even within the broader asset allocation framework, even within the broader instrument selection, there could be certain plays where you have a whole lot of conviction. It could be something as simple as you have a lot of conviction in a particular fund, let's say a fund ABC managed by a certain fund manager. You believe in his ability to play rather aggressively at this point in time in the market, business, and economic cycle. You would want to heavily invest towards it. So sizing your bet in alignment with your conviction, with the strength of your conviction, it becomes a very critical deciding factor on how successful are you going to be, even as an aggressive investor. Now think about it: if you do not have the the right amount of strength in your own conviction, and you invest big, there are chances that you go wrong. And even if there is something where you really believe in something and it indeed does play out, but then you realize that you've hardly invested 5% of the corpus that you could have actually allocated, it's not going to make a whole lot of sense, right? So it's important for these two things to come together for you to be able to optimize your aggressive portfolio and ensure that you stick to the agenda of return maximization.
Oh, absolutely. And I'm so glad you brought on the point of fixed income as well, because a lot of people feel that if you are creating an aggressive portfolio, there is no business including debt, right? And that is such a misconception. So I'm glad you brought that on point. Aggressive portfolio doesn't mean you go and put all your money into the small cap fund. But Nirav, just for the sake of our viewers, what have the returns typically been like? What can they expect, looking at history for the past 10, 20 years?
Yeah, so by it has been my personal experience because I see various portfolios. I have seen varying degrees of performance even
Yeah.
within aggressive portfolios. But if I have to put it all together and draw a curve around it and a bell curve around it, a bulk of the returns have been in the range of 18 to 22% for most investors in the past. However, going ahead, a few dynamics are changing. The past 2 decades are going to be nothing like the next 2 decades, right? Like, for instance, we would probably enter a regime of relatively softer interest rates, so that brings down your risk-free rates, and returns need to be moderated slightly from there on, right? And as the markets are also becoming more and more efficient, so like I always say, it is best that you prepare for the worst and then pray for the best. So it is only sensible to peg your expectations in the range of 15 to 18%. I've never seen anyone who pegged his expectations at 15 to 18% and was really disappointed because he generated 22%. But I've seen the other way around happen more often than not. And one thing you must realize, that expectations and behavior also have a very important role to play in your investment success, because as soon as you start getting disappointed, and if you don't really have a very strong handle of your own emotions and your behavior, you might tend to make certain calls out of desperation, which could probably derail your strategy or your plan that was supposed to do really well had you not touched it at all. So please ensure that your expectations are also in range. 15 to 18% is a damn good figure. You can talk to any fund manager, they would say that it requires exceptional degree of skill to develop such returns. So even if you're chasing this, I feel it is a worthy chase. And as the power of compounding takes over in a couple of years, you'll realize the actual power of this 15 to 18% compounding. For those who may be feeling that it's slightly low for an aggressive portfolio, I request you do the math and then see if it is that much.
All right, Nirav, actually, you have done the math and you're going to help us understand, right, how we can create, an amount of 5 crores in 10 years or 10 crores in 20 years. This has been a very, interesting exercise that Nirav did share with us. So we're going to take you through how you can create that corpus on the other side. Take a quick break and we'll be right back. Hey guys, welcome back. You're still tuned into MF Corner here on CNBC TV18, and I still have with me Nirav, our Karkera, and he's talking to us all about creating an aggressive portfolio. And now what we're going to look at is how you can really build a large corpus. So we're looking at two scenarios. One is how you can create 5 crores in a period of 10 years, and then how can you create 10 crores in a period of 20 years. Nirav, of course, there is, a bunch of ways you can go about doing this. You can put in a lump sum amount if you do have it. You can do it via, an SIP or even a step-up SIP. So let's, go through all of them one by one. If you're trying to create 5 crores in 10 years, how much will you need to put in as a lump sum right now?
So I will stick to the assumption of 15% to 18% of returns. And, if this were to be assumed, you'll realize that if your wealth were to grow at the rate of 18%, then you'd require to make a lump sum investment of approximately 1 odd crore. And if it grows at a much lower 15%, you should ideally invest a lump sum amount of 1.25 crores. So the range is anywhere between 1 crore to 1.25 crores.
Okay, and then if you were to look at an SIP, which is that every month you're investing the same amount of money, then how much would you need here?
So for the same target and considering the same expected performance, an SIP in the range of 1.5 to 2 lakh rupees should get you there. As your return expectations move higher, you start inching towards a lower SIP contribution. But it's always best to stick to the higher side of it, even as a margin of safety. So you should target investing 2 lakh per month, and then expect such performance.
Okay, and something that we always, or any expert that comes on the show always recommends is that as your salary goes up, if you can increase your SIP, then there's nothing like it. So if you are to sort of go about that route and, every year maybe increase your salary, increase your SIP contribution a bit, could you take us through how much you would have to invest then and how much it would increase by?
So a standard assumption would be that your ability to contribute to an SIP should increase anywhere between 10 to 12%. So the step up assumed would be 10 to 12%. And if you're probably targeting a much larger corpus of, let's say, 10 crore in 20 years sort of a span, you can easily invest with a much relatively smaller amount of around 30 to 40,000 per month also. And if you are investing for the 5 crore target within 10 years, an SIP of 1.3 to 1.4 lakh should suffice, considering you'll step it up by 10% year over year.
Okay, so it does bring down your the amount you need to put in at the start by quite a bit. Nirav, the next question is, now let's take a slightly longer time horizon. We'll take a 20-year kind of horizon. Say someone is, very young, they're looking to get in and just want to create long-term wealth, but they're also looking to create a larger corpus. So they're looking at, say, 10 crores. What is the kind of lump sum that you will need here?
So for such a long horizon, the investment requirement comes down significantly because then you have time working in your favor. So for those who want to understand it in more perspective, just recollect your compound interest formula. You'll see time is an exponential factor over there. So if you were to assume a 15% growth rate, you're good enough by investing a lump sum of 60 lakh rupees. And if you're expecting a higher growth rate of, let's say, 18%, then approximately 35 odd lakhs. So your sweet spot lies somewhere in the middle.
Okay, so I mean, that is the kind of difference that it can make, right? If you have such a long time horizon, and that is why, of course, it is always recommended to get into these investments much earlier, as soon as you perhaps can. But Nirav, if you're looking at the same kind of corpus, but you want to go via the SIP route, how much do you suggest someone put in?
So for the same kind of corpus over the same tenure, an SIP investment of anywhere in the range of 55 to 80,000. Again, depending on the return expectation, I feel the range of 55,000 to 80,000 should help achieve this target.
Okay, so this is becoming, more and more interesting, because I think for a lot of people, when you start talking in these numbers, it becomes more sort of achievable, right? Then you can sort of look at trying to put in that money much earlier. But now finally, if you look at a step-up SIP for this same kind of time period, for a 20-year period, how much does that figure change?
So this figure would be much lesser. It would be a much more comfortable figure. I feel this figure will motivate everyone to invest towards this goal. It is approximately 30,000 to 40,000 per month, and with a step up of approximately 10 to 12% every year. So, for those who feel that even 30 to 40,000 is far too steep, let me assure you, start with whatever amount you have and commit to the step up. Your end corpus is going to be fantastic. 30 to 40,000 is for a target of 10 crore rupees. Even if you get towards 5, 6, 7 crore rupees, I feel that's not bad.
Yeah, and you never know, right? I mean, there will be years when you feel like you can increase it by more than 10-12% as well. So I guess the key over here is to just start early as soon as you possibly can. Nirav, you've told us how to go about creating this kind of corpus, how much you need to put in. But I'm going to go one step further and ask you the funds that you would recommend, the fund categories as well. And, if you can name some specific funds which you think are good for this aggressive approach.
Absolutely. So, one thing that I want everyone to understand and take cognizance of is, probably recall the very first statement. There is a difference between being aggressive and being reckless. We are going to focus on return maximization, but we are not going to turn a blind eye to risk management at the same time, right? So everyone must remember that Rome was not built in a day, but hypothetically it can be destroyed in one. So that amount of consciousness is important. Utilize a mix of, probably sectoral thematic plays, mid and small cap plays, and this is within your equity segment. If you are moving on the fixed income side of life, you could probably take on some credit plays and some duration plays depending on where you are in the broader economic and interest rate cycle. There are a few funds on the equity side that we are highly confident of. It would include Quant Small Cap Fund, Motilal Micro Cap 250, which is a passive fund offering exposure into the micro cap segment, a really unique fund. Edelweiss Mid Cap Fund is one of the really well managed, actively managed mid cap funds in the space available. There are a few more that one can see. It could include Mirai Asset Fang Plus, which invests in overseas big tech, in the biggest of biggest tech companies that each of us are aware about, and Invesco India Contra Fund, which brings in a contrarian approach. At the start, we spoke about building a conviction into ideas that are out of favor. Invesco India Contra does that really well. ICICI India Opportunities, outstanding fund. And for a sectoral mix at this point in time, considering our view on this sector and the valuations, we believe Nippon India Pharma Fund and Invesco India Infra Fund and SBI Technology Fund are a few good sectoral plays at this point in time for really long-term investors.
All right, this has been extremely helpful, Nirav. Thanks for taking us through the A to Z of really creating an aggressive investment portfolio, but also putting the warnings on the table and, telling our viewers that there's no need to be reckless even when you are building an aggressive portfolio. And like he pointed out, with any kind of investment, there is a framework to be followed, and it will only help you in case of such a long period, because typically this kind of aggressive investing is looked at for a longer period. Nirav, it's been a pleasure to have you on the show. Thank you very much for joining us and taking out the time. I hope that helps all of our viewers. This is how you can go about creating an aggressive mutual fund portfolio and how you can get to a very large corpus. But with that, we're going to wind down. Thank you all for tuning in. We have closing bell after this short break.